Oh boy. Tattooed Chef are getting a whooping, and they're currently 15% down. And I've just opened up a new position in TTCF. I've been convinced, guys. So, the very popular stock amongst a lot of YouTubers and retail investors, Tattooed Chef, is down 15% as we speak. So, it's sitting at 17.25 as we speak, down 15%, which is 3 points on the day. And the reason for that is they missed earnings. So they came out with a quarterly loss of 9 cents versus an estimate of 1 cent. So in essence, that's an 800% miss on expectations. Now, the problem is there was a loss of 7 cents in the previous quarter, and the previous quarter they were actually expecting 2 cents profit. So they're missing on consecutive quarters, and that's the problem here. But what we need to remember as investors looking for these opportunities in the rough is that these companies are fast growing. And sometimes when you get fast companies, the reinvestment curve is something you need to be looking at. And sometimes you just need to be picking up on fundamentals versus just looking at the earnings, because various different circumstances can have an impact on just the pure number. So if you just every quarter looking at the pure number, it can mislead you, and sometimes you can miss out on picking out these gems. So let's take a look. Let's take a look at their filing. So let's have a look at this together. So it says the growth we have experienced in the first half of 2021 is a testament to the strength of Tattooed Chef brand and the ability of our team to execute. So that's Sam Galetti, the CEO. We are firing on all cylinders, winning distribution in leading national retailers like Kroger, Publix, Albertsons. So let me give you an example. This is what I mean about looking at the fundamentals versus actually looking at the numbers. So let this Q2 report be from Jan to June. Now let's hypothetically say they closed a deal with Albertsons in July. Now that's not going to show up in any of your earnings. Okay, but it's going to have a massive impact going forward that you're managing to close these deals with leading national retailers. And our velocities are outperforming the competition. By the end of the third quarter, we expect our branded Tattooed Chef products will be in over 12,000 retail stores, exceeding our previous goal of 10,000 stores. Furthermore, with the acquisition of Foods of New Mexico in May, we have ample production capacity to achieve over 500 million in revenue. Okay, so that's their goal. They want to achieve the 500 million in revenue. Now, Sarah Galetti seems related to Sam Galetti, Chief Creative Officer and the Tattooed Chef. Okay, that don't make sense. I mean, at the Tattooed Chef, maybe. Added, we are still in the early innings of growth as we prepare to expand Tattooed Chef beyond the frozen aisle and refrigerated and ambient products later this year. Fine, let's look at the headlines. So, revenue was 50 million, which is a 45% increase compared to the 34.8 million in the prior year. Okay, very good. And it increased 62% compared to 20.4 million in the prior year period. Okay, very good for the branded product revenue. So we can see total revenue is up 45%, and the branded segment, which is going to have higher margins for them, is up 60%. So that's exactly what we want to see. We want to see penetration in that own branded product, which is difficult to get up and running, tick up. Gross profit was 8 million, 15.7% gross margin compared to 3.7 million or 10%. So 5% increase in gross margin. So that's very good. Net loss was, and this is where the market didn't like it, was 53 million compared to net income of 1.3 million in the prior period. This loss includes a one-time non-cash expense of 46 million resulting from a valuation allowance on a deferred tax asset due to additional investments. So this is very important, guys, because you take off this 46 million and now suddenly your loss is 7 million, and it's not as bad as it looks here. So the headline figures scaring people out. You've got to be careful of these things, and you've got to read these filings instead of just opening up Seeking Alpha, or opening up CNBC and reacting off of the headline ticker you see and getting out of your position, panicking and not doing your due diligence. Really important we do that. Adjusted EBITDA was negative 5.9 million compared to adjusted EBITDA of positive 2 in the prior year period. Adjusted EBITDA is a non-GAAP financial measure defined under non-GAAP. We know that. Okay, fine. Let's see what they're saying here. So we saw that. We read revenue, we read gross profit. Now let's have a look at operating expenses. Operating expenses increased 13.8 million to 15 million, so it's a massive increase in the 3 months ended June compared to 2.1 million in the 3 months ended to June 30, 2020. So year on year, they've gone from 2.1 million OPEX to 15 million. Okay, and that is massive. The increase in OPEX was primarily due to promotional expenses of 3.2 million, marketing expenses of 2.9 million, and professional services, including legal and accounting, of 2.6. So this is definitely an area we'd want to get into. If we want to build a larger position in Tattoo Chef, I'd want to get comfortable understanding more about their OPEXs and SG&A. What are they spending on? How effective are these ad campaigns and the marketing efforts they're making? Is it actually converting into revenue at the top of the funnel? Net loss was 53 million. Yes, we know that. Adjusted EBITDA, we discussed as well. Cash position, 114 million. Okay, a decent amount of cash for a food company. And that probably means that they won't need to raise any financing. But we'll have to wait and see about that. Let's see what outlook they shared. So they're saying for the full year 2021, revenue in the range of 235 million to 242 million, an increase of 58% to 63%. Compared to 2020. This guidance implies 49% year-over-year growth on the base business to 222 million and a 13 million to 20 million contribution from one of the 2 facilities included in the Foods of New Mexico acquisition. Okay, the company does not expect the second facility, Carsten, to have a material impact on 2021 revenue because of the timing of equipment being installed during the fourth quarter. Gross margin in the range of 16 to 22%. So we already saw that the gross margin came in at 15.7. They can see a few more percentage points at least to be achieved there. Well, that better be the case because they've got to sell a story to the investors anyway. And they expect adjusted EBITDA of negative 14 million to 17 million. Look how wide a range that is. The company is committed to an aggressive growth plan. Its brand for extensive marketing and promotion. This is what I'm concerned about. They're talking a lot about, oh, it's fine. We're just going to spend a load of money on marketing and promotion. We've got to be careful about this. To augment the revenue growth, the company's invested in its staff and infrastructure, equipment, brand visibility, customer acquisition costs to meet the marketplace demands. Okay. CapEx in the range of 15 to 20 million. Okay, let's flick on. Let's get to the good stuff. Right. This is what we wanted to look at. So if we're just looking at the quarter, okay, just Q2, they've got from 2020, they've got added 34 to 50. And if we're looking at the full 6-month period, the first half of the year in 2020, they delivered 67 and they've delivered 100 million in the comparable year. And that's impressive given that we had COVID. A lot of people thought that Tattoo Chef would benefit from it, but then maybe they'll suffer as COVID starts to subside. Cost of goods looks sensible, looks in line. No concerns there. Gross profit, interesting. Actually, that looks a bit worrying there. So if you look at let's have a look at that together. So before they were doing 54, let's call it 55 on 68 of revenue. Okay, so the 80% was cost of goods. Now, if you look at it, they're doing on 103 revenue, they're spending 89. Okay, so they've gone to 86%. That's a 6% increase. You can look at that. They're doing all this much more work to get 100 million, and that's giving them on the bottom there an extra million, less than a million. So the revenue's looking good, but they're spending a lot of money. So they need to really streamline their COGS, their cost of goods sold. And then let's look at the bottom line, because no doubt that's the area we want to focus on, as well as the SG&A items we just mentioned. So now if you look at their OPEX, let's look at their OPEX. So here, their OPEX, since this is all they've provided us, stop snapping over there, come back here. So their OPEX was, you can see in 2020 first half, 4, call it 5, just to make it easier, on 68 revenue. Okay, so 7% of their costs was in OPEX. Now, if you look at the current period, 29, let's round it up to, which is this figure here, and I want to take that as a percentage of their revenue, call that 103, they're running at 28%. So the OPEX has massively spiked. Now we need to understand, I don't know if they're going to provide this here, we need to understand what's going on in this CapEx. Not only has their margin fallen, their gross margin, but their OPEX has taken a hit too. They're spending a lot of money in this quarter. Now, we don't want knee-jerk reactions. This is the problem with looking at finances on a quarterly basis. Sometimes there are one-off ad hoc spends which can happen, exceptional items, investment in things, and that can skew a quarter's readings, right? And we don't want to panic on these types of figures. But it'd be good to understand it so we can see if we're trending in the right direction or if the management are going in a direction which we're not agreeable with, which is the whole point of understanding earnings and learning about earnings. And that's what then gave them their loss, okay? So that's what's delivered their net loss of 61 million versus where they just about were slightly profitable in the same period last year. Okay, and we can see this is what's interesting. You can see that this 28 million of OPEX wasn't just in Q2, because 16 million of that is in Q2, and the remainder 13 million was in Q1. So it's a bit worrying that it's over 6 months, so we don't want this to become the trend. So if it was a one-off exceptional item, why is that going on over 2 quarters? We need to do some investigation. Okay, let's see what else they provide. We know they're healthy on the cash position. Let's look at their total assets. 280 million, total liabilities. That's an amazing, that's an amazing ratio there. They're very comfortable here in their asset test of asset versus liabilities. And I think that's where they'll leave it. Yeah, so 53 loss. So there you have it, guys. That's a quick walk through the Tattooed Chef earnings call. Like I said, they're getting hammering. I just took a little nibble. Couldn't resist. Whether I'm going to build a longer term position in Tattooed Chef, I don't know. I will update you here as and when I do my research. It's been on my radar for a while, but I do need to get a better understanding of the company and spend more time understanding it. I'm going to listen to this earnings call later on. I suggest if you're interested in the company, you do the same, just to try and understand management, where they're heading, what direction they're trying to head in, and to see if the company has any legs. I was a bit concerned with, coming into these earnings because Beyond Meat struggled with their earnings too over the last few quarters. So I just wonder whether this is a trend in the industry or whether it's just a blip. Got some more research to do there, but there you go, guys. That's the Q2 earnings for TTCF, and I'll see you in the next one.